Howdy there, folks, and welcome into tonight's video. So in this one, we're going over what Cathie Wood just said. Less than 24 hours ago, late last night, Ark Invest uploaded a video of Cathie Wood talking about several different subjects. And I think all investors, if you're in the stock market, you should pay attention to what she's saying in this video because it affects you, it affects your stocks, and perceived values and those sorts of things. So there's three specific segments we're going to go through. We're not going to watch the full 47-minute video, although if you want to watch it, obviously you can go to Ark Invest and check that out. We're going to watch 1 minute through 13 minutes. I'm going to give you my analysis of that part. We're going to watch 32 minutes through 36 minutes. I'm going to share with you my analysis on that part. And the last one is 41 to 44 minutes because I think those were the three most important parts of this entire 47-minute video. So I hope you guys enjoy a little video like this where we go over something like this. Very, very important because like I said, this affects your stocks. It does affect your money at the end of the day, okay? So let's hear what she has to say.
I have been giving weekly or monthly updates. Now, why have I done that? For a couple of reasons. During the coronavirus crisis, when it hit, it was clear to me that the headlines that people were reading, generally, both investors and the general public, were not capturing what was really going on in the economy. There were a lot of economists, famous economists and others, strategists as well, who were looking at the economy shutting down and we're basically preparing people for a depression, if you'll remember. And you can go back to those videos. In the early days, they were called Stay at Home with Cathie, and then we switched to In the Know. And as you know, back then, I was very focused on the possibility that this was a shock from which we would recover very quickly. And that turned out to be a correct call. And every week in the beginning, and then...
That could have easily flipped the other way, right? If the Fed wasn't there to rescue and if we didn't start opening up the economy, much more rapidly than a lot of folks anticipated. Because there was thought during that time that like the entire economy was going to like basically close down for like possibly 2 to 3 years they were talking about at that time. So to be fair, like, it didn't get that way because we didn't really let it get that way.
I was delving into the economic reports that were coming out and into the earnings reports and pulling out evidence that supported or refuted that point of view. And that worked. Well, today we have a very different point of view, once again, about what's going on out there. And so that's why we do these videos. And I will get into that in a moment. That's
very, very important. She's got a very different point of view than the market does. And we know the market right now has a certain view of Cathie Wood stocks. What is that view? That all those stocks are bad. They all deserve to go down. It's very clear. You see in the pricing of these stocks. I mean, look at Teladoc, look at Zoom, look at most of Cathie Wood's biggest investments. They've just been on a vicious downtrend. So the market's saying one thing about Cathie Wood stocks. Cathie Wood has a whole different view on this, right?
I'd like you to alert you to a blog that I wrote in mid-December. It's on our website. And it goes into why we believe that innovation is in deep value territory and goes through and refutes a lot of what we believe are the myths out there about
deep
innovation.
Value.
We believe that COVID-19, the coronavirus crisis, accelerated the shift towards the innovation platforms around which we have based all of our research. And I'm going to give you a few examples of that in a minute. I do want you to know that, of course, we've been through a very difficult time since the significant rotation from growth into value started nearly a year ago in mid-February. And I want you to know that we're in there with you between the company and Ark.
I like this. This part, she's really speaking to the investors who have been getting destroyed in a lot of these stocks or in the ARK fund itself, right? Which I think is a good thing, because she goes into basically how her money, she puts her money where her mouth is, and, she thrives when these stocks do good, and when they get hurt, obviously her net worth goes down. So I respect that. That's something obviously I try to do, and I think that's something all investors should do. I don't like it when people speak highly of stocks or this and that, and they don't really have any skin in the game. It's kind of lame.
Funds, which are more than half of my IRA. and the significant percentage of my total net worth, we're all in. And my conviction couldn't be higher that the innovation that has been evolving and was accelerated coming out of the coronavirus crisis is unstoppable. And the convergence between and among the 14 different technologies that we are researching, that convergence is underway now and is causing and will continue to cause explosive growth, really the likes of which we haven't seen in our lifetimes. And when I say explosive growth, I mean when it comes to those innovation platforms, they're going to cause a lot of problems for the underlying economy, the traditional world order.
To understand Cathie Wood's investing philosophies, she always talks about disruption. And so essentially what she's trying to do is place her chips on the table in companies that she thinks are disrupting other massive industries, right? So think about Tesla disrupting, obviously, the automobile industry, as well as the energy industry as well. And so anything she really gets into, it's got to be like disrupting basically other industries that are out there. That's like her specialty, essentially.
And
which makes me think we got to get her on the plant-based movement. We got to get her in some of these plant-based stocks. We got to get her in the Chef. We got to maybe get her in BYND. We got to for sure get her in Oatly. A lot of plays out
I'll
there.
Explain a little bit more about that in a moment.
Honest?
So what has happened is in the early stages of the coronavirus, when I was doing those videos, we had algorithms and quantitative strategies focused on just a few variables. They were at that time cash burn and cash cushion. And a lot of our stocks did not have big cash cushions and were burning cash, especially in the genomic space. And they were taken down by 75%, many of them, in a month, just in a month, 3 weeks to a month. And of course, that was the wrong answer. The algorithms got it wrong, and that there was a massive head fake, caused a lot of consternation for the quantitative strategies out there, because, of course, genomics was a big part of the solution to
just to back that up for a moment there. I mean, that sort of market, it was incredible. It was the fastest stock market drop we ever had, 35% in 22 trading days, and then how rapidly it came back. I mean, it came back so much faster than myself or pretty much anybody had anticipated. It was incredible.
A problem we were facing in the coronavirus. And since February, as this rotation into value from growth really accelerated, these same algorithms have had good success with this strategy. They've been focused on inflation fears, interest rates, and valuations. And they have likened what we're going through right now.
Notice how she keeps talking about algorithms. She's not necessarily saying fund managers. She's talking specifically about algorithms are making certain moves. Which we know a lot of the market is driven by algorithms now.
To the tech and telecom bubble and the bust. And so the algorithms as well are basically looking at momentum and saying, once the bubble pops, that's what they're calling this, it doesn't stop. It's 80, 90%. We think that is a vestige of the tech and telecom bubble and bust. A lot of strategies started moving towards benchmark sensitivity because of the tech and telecom bubble and bust. And they really stopped focusing on true innovation.
What she basically means is back in the tech bubble days after, it kind of went, right? A lot of folks funneled money into essentially, what are seen as safer stocks. And out of anything that was considered innovative or disruptive, anything like that. And that's why even a stock like Amazon stock was a 93% peak to trough in that whole situation because everybody just flooded out. And whenever you have a scare in the market, that's what happens. Everybody floods to what is seen as safety and out of anything that is seen as risky. And you could go back to the 08-09 recession. Same exact thing happened in the market. By about 2011, 2012, people were starting to take real risk in the market again. But for 09, 2010, and even 2011, for the most part, a lot of folks just did not want to take risk in the market during that particular time.
Formative innovation, disruptive innovation. So the gleam in the eye, the dream during the tech and telecom bubble, investors were falling all over themselves to get the next deal and to ride it, up hundreds of percent within a few days. And of course, that was not real. I'm going to read you some of the companies that went poof from that time.
It's identical. What happened in the tech bubble is identical to what's going on in the crypto market right now, where people are just way too early days in that and pushing up valuations to sky high levels, right? This has a $20 billion market cap. This has a $1 trillion market cap. This has a $300 billion market cap with things that don't deserve that at the moment. And this is what happens when you have just different bubbles out there in general, right?
These were the largest .com busts: Pets.com, Webvan, eToys, GeoCities, TheGlobe.com, Go.com, Flues.com, DrCoop.com, and Cosman.com. Many of these were out of business within a few years because they were being priced on nothing but eyeballs, not just current eyeballs. Dr. Coop, for example, averaged 1.4 million monthly average users, or the equivalent thereof. And it went public in June of 99 and was out of business in December of 01 because the valuations that people chased were simply based on eyeballs that might materialize and never did materialize. We are nowhere near that situation now. The dreams back then, so the internet was quite transformative and led to the cloud and artificial intelligence. We are living in the reality that dream started. And this reality has companies like
And just so you know, the tech bubble that started over 25 years ago now. That's how long ago that was. Some time has passed, and literally what she's describing is literally the crypto market right now to 100%. Only thing is, a lot more people are involved in the crypto market right now than actually were involved in the tech bubble back then.
Okay. And Zoom, just to give you a sense of the contrast here. Teladoc has about $2 billion in sales. Its revenues have gone up fourfold since the beginning of the coronavirus. And we don't think that its revenues are going to go down. What we're seeing in the market is a focus on year-over-year momentum. And the comparison...
That was key. She says right there, Teladoc, we don't expect the revenue to go down. Neither do I. I don't personally own Teladoc stock, but I've looked into the company a lot over the last few months, and no, the company's going to continue to likely grow for years and years and years and years to go in the future. The only debate with Teladoc is what rate of growth does it have and what is their profitability long term?
That we're going to see, and this is the last of the really tough comparisons. Zoom's revenue 1 year ago, fourth quarter, was up 370%. And in this fourth quarter, the quarter they will report soon, we believe, and their guidance is that revenue will be up 19 to 20%. Think about that. On top of 370%, up 19 to 20%. And that's probably the low point of its growth rate.
So what she's talking about there is very, very important, because she has a point. Coming off of 370% growth or whatever, 390% growth, to have 19, 20% is still amazing, right? But the way the market looks at that many times is that is a massive, colossal deceleration in growth, right? Oh, you were growing 370%. Now you're only growing 19%. What's next? You go negative. And especially when it comes to algorithms, right? They don't really know how to read that and decipher that information. All they know is that's a ridiculous decline in the rate of revenue growth, right? One of the most insane you've ever heard. So sell, right?
And we're going to accelerate, we believe, or Zoom's revenue growth is going to accelerate from there.
And that's very key. When you see I brought this up in a video recently. I just want to take a second to explain this idea and this concept, okay? This is very important. When we're talking about an acceleration of growth, that doesn't mean just growing year over year. That's just growing year over year, right? So let's say you grow revenues 10% year over year. Okay, cool. You grew revenues, right? What's impressive is, let's say last year you were growing revenues 10%, and now this next year you're expected to grow revenues 20%, right? That's what you call an acceleration in growth. It's an acceleration rate in the revenue growth, right? And that's when you see a lot of stock prices go insane. I've seen it time and time again. When a company has its growth accelerate, people are like, it blows your mind, because that's not natural for companies. It's natural for companies to grow their revenues over time. It is not natural for companies to have a re-acceleration of growth to a faster clip than the past year or the past quarter, things like that, okay? So very, very, very important to keep in mind. And many times when you see that happen, the stock price starts to reflect in a massive way. And next thing you know, you see that stock double up, triple up in a pretty quick amount of time.
I gave you Zoom. Its revenue, is up 6.5-fold since the beginning of the coronavirus. Teladoc, another stock, telehealth, its revenue is up 4-fold. And the Teladoc's revenue is $2 billion on average per year, or this last year. Zoom's about $1 billion. So these are real companies. Their gross margins for Teladoc, they're in the 60s, high 60s. For Zoom, in the low 70s. I may be mixing some of these numbers up, but you've got the point. Very high gross margins, solid revenues, growth continuing from very tough comparisons. And we've got two companies here that are being dismissed as stay-at-home stocks that are going to fall back to earth. And we believe they are not stay-at-home stocks. They are stay-connected stocks, stay globally connected,
Yeah, and I don't personally own Zoom stock or Teladoc, but she's got a phenomenal point. Like, Zoom's going to still be highly relevant, more relevant likely in a year or two from now than it was in the past year or two. Teladoc, same exact situation. And, in the last point she's really bringing out here is the fact that you can't compare this to the tech bubble and those sorts of things, because those companies, a lot of them didn't even have business models. Like, Teladoc's a real legit business model that has substantial revenues, right? In gross margins, same exact thing with the company like Zoom, right? So yeah, that's a main point she's making, because some people try to say, oh, it's like the tech bubble. Oh, no.
Competitive, stay globally competitive. Teladoc being the backbone of the healthcare system from an information point of view here in the United States. And Zoom becoming one of the most important companies, we believe, in the enterprise communication space. Communications is a $1.5 trillion market, enterprise communications globally. And we believe that Microsoft and Zoom together are going to benefit from the first quote unquote, rip and replace cycle since the early days of the internet in the early 90s when Cisco came of age. We believe that the dismissal of these stocks is quite misplaced and suggests that analysts or investors are not doing their homework and sizing these markets appropriately. So what I'd like to do in terms of focusing now on inflation, interest rates, and valuation is leave those aside for a moment while we go through monetary policy, fiscal policy. Focus on here is China.
China time.
So much is going on in China that, again, the headlines are getting some of this, but this
is really good stuff, that she's going to give out here in regards to China. Very, very important.
In 1 week, a Bloomberg journalist, Sofia Horta Acosta, reported that all of this happened in Greater China this week. I'm going to just read you a few of these to give you a sense of the drama here. Evergrande suspends trading on the stock exchange. And the developer, Evergrande, was ordered, think about this, to demolish 39 illegal buildings because they didn't have the right permits. Can you imagine if that happened in the United States?
It sounds so ridiculous. Like, it's such a sketch thing. It's basically just the Chinese government, like, understanding, like, you guys, we've been way overbuilding, because it's all one and the same. Like, we've been way overbuilding, and let's just destroy the properties. It's a crazy situation.
The 100 largest developers in China reported that their contracted sales were down 35% in December. And for the year as a whole, they fell for the first time, Sophia says,
China literally does not care about the environment. Like, think about how much manpower and how much, environmental damage had to be created to create 39 buildings. And then they're like, well, it doesn't have the right permits, so I'll just destroy it. Like, they literally do not care even 1% about the environment. Like, it's incredible, really. It's sad, but whatever.
Least 5 years. I don't think I've ever seen them fall in the last 20 years. So real change. Hong Kong's instituted strict.
I want to go back there.
I've ever seen them fall in the last 20. Contracted sales were down 35% in December.
Sales.
And for the year as a whole, they fell for the first time, Sophia says, in at least 5 years. I don't think I've ever seen them fall in the last 20 years. So real change. Hong Kong's instituted strict border controls, banning arrivals from US, UK, Australia. They are shutting down bars. They're shutting down evening dining. Let's see, a few of the other developers went bust. Shimao, which was rated investment grade in November, defaulted on a trust product and rocked the credit market. And the central bank withdrew liquidity. A lot of people thought they were going to increase liquidity because they said they would. A China regulator vowed stability after stock market's rocky start, but they haven't done anything about it yet. And very interestingly, the yuan, the RMB, the local currency, after a very strong year, held up. And I think it held up probably helped by the government, supported by the government. It is starting to weaken, quite a telltale sign. And one stock, Hurong, which had not traded since last March, opened this week and dropped 50%. Now, when China catches a cold, commodities usually catch pneumonia. And we're seeing this in a few commodities, iron ore prices and so forth, but it isn't quite clear cut yet. And I was saying to our team this morning, how could this be happening and the economy not be falling apart and the consumer not getting restless there? Well, the consumer savings is 75% in real estate. But what I learned this morning, and it does make sense, one of our analysts, our newest genomics analyst, Pierce, worked in his lab as he was getting his PhD at Texas A&M with other Chinese students. In fact, he only worked with Chinese students. And he learned that a greeting in China, the equivalent of a hello, is basically, I hope you have enough to eat. And so pork prices and rice prices are critically important. And what do we see happening there? Pork prices are down, depending on the measure, 33 to 50%. Rice prices are fairly flat. And apparently that keeps the consumer happy. Now, I don't know. I think that
they need to move to plant-based diets in China.
Property debacle is quite something, so we shall see.
100%, it is quite something, and the thing is, when you're dealing with China, it's so hard to get the truth, I guess you can say, out of it all, right? You don't know what to trust and what not to trust, and what's being government-fed propaganda versus, it's tough.
And I'd like to end right now by talking through just one more thing, going back to autos and giving you a sense of...
This might be my favorite part of the whole deal. Like, this part is classic. Okay, I love this.
The bubble might be in this market. It is not in innovation stocks. They've been cut in half, many of them, some by 75%. But listen to this. I gave you the story about Ford reporting that it would have to double its electric vehicle production of the F-150 Lightning, and the stock just taking off, not paying any attention to the auto statistics I just mentioned. Well, when I think of what could happen in that space, and I see these stocks ramping on sales that mean nothing to these companies in terms of their earnings, shall we say, right now. In fact, they need to invest a lot more in electric to make it happen and to move the needle in these companies. But what if we're right and there is not a 20% increase in sales? Maybe sales are flattish year to year. That would put them at roughly 15 million units. And they'd probably have to start cutting prices if we're right on the used car market and the pricing there, which means they're probably going to be facing some credit issues since they're hugely leveraged to the credit that people take out on their autos. And as prices go down, residual values go down. And, auto credit was the best performing credit in 08-09. And so there's a lot of complacency in that market. In 08-09, the homeowner had to decide, okay, I can't pay everything. I'm out of work. What do I pay to just keep things going? Well, they were going to pay their auto loan down and default on their mortgage because it would take a while for them to get kicked out of their house, but they needed to get to their jobs. Today, that would change because of ride hailing.
It's just so good. It's just so good, man. You know what I mean? Like that's one of those very nitty-gritty points there on something that happened 14 years ago that I think is just so vital. And you're not going to hear that sort of analysis out of very many people. And that's just the stuff I respect on such a high level, honestly. It's beautiful.
So we think that complacency is...
I think if you're like newer to the market, you probably don't even like realize that last like 45 seconds you just heard, like how classical that is. It's just so beautiful. If you've been in the market for a long time, you know what I'm talking about. Like, this is beautiful, man.
And that the auto credits out there could become a mess. So if I'm right on any of this, there will be disappointments in terms of the auto sector. And I wouldn't be surprised if at least one of the companies loses money next year, which would be most unexpected. And if it loses money, what is that valuation? Where are the crazy valuations now? Are they in our stocks? Now that Zoom is down to 33 or 35 times this year's earnings? Or is it in an auto stock where there might be losses? And what's that PE ratio? That's infinity. That's where the bubble is. And I think you're going to see a lot more cases in point as this year moves along, and the innovation that we see evolving so rapidly, DNA sequencing, transforming healthcare.
Oh, that was beautiful. That was just a beautiful way to kind of end the video there, because she brings up a great point. It's like, people could talk about Tesla's overvalued or this stock's overvalued or whatever, right? And it's like, okay, wait till the auto market slows down and ICE vehicles slow down at a much more substantial rate than that, right? And what's it mean if all of a sudden some of those companies start actually losing money, which is very much a possibility. Okay, and I don't think a lot of Wall Street's even taking that into account. And those companies flip fast. If you've paid attention to the auto sector over time, things flip fast, where it's like the best ever, and then all of a sudden, whoo, it switches quickly, right? And in that sort of situation, imagine a lot of those companies start actually losing money. The only reason people are in those stocks is because they make a lot of money, right? And if things all of a sudden flip, oh my gosh, the sell-off. How you going to all of a sudden say those stocks are undervalued at that point, right? If it's not making any money, what good is it, right? So anyways, guys, hope you enjoyed this video. And if you want to check out that full video, check out Ark Invest, obviously YouTube page. Much love. Hope you enjoyed a video like this. Let me know in the comments if you did. Don't forget to subscribe, and peace.